Hi, and welcome to this presentation on insurance companies and pension plan. This is chapter 2 of the Financial Markets and Products, book number 3 of the FRM curriculum, part 1. So without much ado, let's dive into the topic. Following are the learning outcome objectives. To describe the key features of the various categories of insurance companies and identify the risks facing those insurance companies. Describe the use of mortality tables and calculate the premium payment for a policyholder. Distinguish between mortality risk and longevity risk and describe how to hedge these risks on the insurance company's balance sheet. Describe a defined benefit plan. This portion is attributed to the pension plan, of course. Describe a defined benefit plan and a defined contribution plan for a pension fund and explain the differences between them. Compare the various types of life insurance policies. Calculate and interpret loss ratio, expense ratio, combined ratio, and operating ratio for a property and casualty insurance company. Describe the problem of moral hazard and the problem of adverse selection that the insurance companies face and how these problems could be overcome. Just like banking system, we also are going to discuss about the capital requirement for the life insurance companies and the non-life insurance companies. And last, the guarantee system that exists in certain economies, mostly the developed ones, which are in line with the regulation. The regulations are pretty similar to that of the banking regulation. And we are going to talk about the guarantee system, which is equivalent to FDIC in banking system. Okay, so let's first talk about what is insurance. So when you think of insurance, we are basically talking about pooling of risk and reward. Pooling of risk and reward. Now, what do we mean by that? Well, it means that if there are 100 people who buy certain insurance in a given year, mind you, the mood point out here is in a given year. In a given year, maybe 1 or 2% of those people are actually going to file a claim. Once the claim is filed, then the insurance companies will make the necessary payment. These payments are called the redemption or claims payment. Of course, subject to certain verification as well. Insurance is not a business with the motive of profiteering. Why? Because the business of insurance is all about hedging of risk. Which kind of risks? The risks which are mostly unprecedented and the ones that can actually derail somebody's life. For example, a sudden departure or a demise of a young person in a family who perhaps was also the earning member of that particular family. Or let's say a corporate which is facing some sort of legal threat, some sort of warranty claim because their product went bad. Now, these kind of eventualities are the ones where the insurance company come to the rescue. So one cannot actually sell an insurance company, trade or gamble their insurance policies. So the business of insurance is not with the motive of profiteering, but it is for the purpose of hedging one's risk. To begin with, insurance as a business can be categorized into two halves mainly. One is the life insurance and another is something called the non-life insurance. Sometimes we call them as the general insurance. The general insurance again can be further subdivided into property or the asset-based insurance and casualty or the liability-based insurance. Life insurance can further be subdivided into ordinary or whole life insurance policies, variable life insurance policies, universal life insurance policies, endowment-based policies, group life policies, and term life insurance policies. We are going to discuss each one of them in a threadbare manner. But first, let's understand the purpose of insurance. And to begin with, we are going to take up the life insurance first. Now, let's imagine a scenario that we are talking about a healthy 30-year-old person, or let's say he is 25-year-old. He has completed his graduation, maybe he has completed his master degree as well, and now he's all set for starting off his professional journey. Assuming that he's going to work for the next 40 odd years, he will definitely have certain liabilities going forward. How come? First and foremost, of course, it's all about his own sustenance, his own establishment, and then it's obviously about getting married and raising a family. Raising a family would eventually also mean, in general, having kids, and to ensure that those kids get proper education so that they can also establish themselves once they're properly educated in their lives. That's how a normal person would think. That's how the life of a normal person actually happens. But let's imagine a scenario that by stroke of bad luck rather, this person, unfortunately, at the age of 45, meets with an accident or has a sudden cardiac arrest, and he passes away. It's an unfortunate incident. But the bigger question is that what happens to his family? Assuming that if he is the only earning member of his family, that means he may be left with a wife and perhaps a couple of kids, his children. Of course, his children are young. That means, and his wife is also young, I would assume. So that means that the person, literally, his departure has rendered these the ones who are left behind, that is his family, in a potentially state of destitution. Why we are talking about state of destitution? Because we assumed that this person is the only earning member of his family. And his sudden demise is obviously going to bring in a lot of financial difficulty to his wife. Not to mention, it puts a significant question mark, a very big question mark, on the future of the children as well. What about their education? What about their marriage? Etc., etc. Now, to come to think of it, that is exactly where if the person has taken out a life insurance policy, that is where he perhaps can actually buy that shield, buy that protection, and ensure that even his untimely demise will not let his wife and his children suffer to the point that their dreams remain unfulfilled. So in other words, the life insurance policy actually replaces or substitute something called as the human capital. What do we call as the human capital? Well, as we said before, if we assume that this person has started working from the age of 25 and is going to work for the next 40 odd years, it is natural that he is going to obviously accumulate some wealth. He is going to build certain properties, certain assets, and obviously he's going to plan for his children's future. The untimely demise of this person would otherwise have put all of those future plans into big jeopardy. But the person, if he has taken out a policy at the right time, that insurance policy will come to the rescue of the ones that are left behind, namely his family. So in other words, the insurance company actually substitutes for the human capital that this person could have actually used to build his wealth and ensure that his wife and kids are actually properly taken care of. So that's the whole purpose of insurance as far as life insurance is concerned. Let's first talk about whole or the ordinary life insurance policy. Actually, there are about 6 different types of life insurance policies that we're going to discuss. First is that of the ordinary life insurance policy. So let's think of a situation that a 25-year-old healthy male takes out a policy and he's expected to live up until his 75th year. So that means he has a good lifespan of 50 years in front of him. The whole or the ordinary life insurance policy entails that this person is going to pay regular premium up until his death. And upon his death, his nominee, that is his family, is going to get the money out of that insurance. That money is called the claim. Sometimes it is called as the sum assurance, or sometimes it is also called as the face value. They are known by different nomenclature, cash value, or simply speaking, your lump sum redemption. So, few things that we need to understand. First and foremost, death is inevitable for everyone who is living. The only question is when. So, the ordinary life insurance policy, or OLI as we call it, does not envisage that the policy is going to lapse at any given point in time, or it is going to expire. This policy is guaranteed to make the payment, provided the person who has taken out the policy continues with this policy up until his demise, and he pays his premium in a regular fashion. If these two conditions are fulfilled, the insurance company will definitely make the payment to the nominees or the beneficiaries. So, whole or ordinary life insurance, as we understand, that it can only be encashed, or it can only come into effect upon the death of that person. So let's understand a few more pointers out here. Sum assured. Sum assured is basically the value of this policy. So for example, a 25-year-old person takes out a policy of, let's say, 1 million US dollar. So for this 1 million US dollar will be said to be the sum assured. So this sum assured is sort of guaranteed. This sum assured is guaranteed. That means there is something going to be crediting rate. In other words, the policyholder pays a premium of, let's say, $5,000 every year. If he pays a premium of $5,000 every year for the next 50 odd years, if that's how things are, then in that case, upon his death, anytime or within this 50 years, the insurance company is going to make payment of 1 million US dollar, which is called as the sum assured. Sum assured is a specific terminology that is being used for life insurance. So it's a fixed assurance, which is basically sum of all the premiums that can be thought of being paid from the 25th year until his demise, with a guaranteed crediting rate. Second point is that payouts are guaranteed, of course, as we said, in the form of mortality. Okay, so there are no cash out value, there are no early surrender value, no, nothing like that is there. This can only be effected upon the death of that person. Premium pay in most jurisdiction is tax exempted. Yes, a government, most of the sovereigns, they actually encourage their citizens to take out insurance policies, because insurance as a business in most of the developed countries, well, though it is well penetrated, the developing countries or the emerging markets or the frontier markets are the ones that are yet to see the development in the true sense. There the penetration level is significantly low, or almost is non-existent. So in such a market, to incentivize the citizens, government mostly comes out with tax SOPs. So these are tax deductible policies. That means the premium that is being paid, those will be deducted from the income suitably, and thus the tax liability will come down, reduce. So payment in most jurisdictions is tax exempted. Even the payouts are not taxed, because the payouts are given on death, and these are given as part of compensation, which we talked about. Compensation to what? Compensation to the human capital. This compensation is being given to the kith and kin of the policyholder. Hence, there is no tax that are being actually levied on the beneficiaries. Now, there are two subtypes to this type of insurance policy. One is called the variable life insurance policy. Another is called the universal life insurance policy. We are going to discuss each one of them suitably. But before that, let's also try and find out that what are the exceptions to any of the insurance policies. For example, let's think of a situation. What happens if the policyholder stops making payment? In other words, in the terminology of insurance, we call that disintermediation. The problem of disintermediation is very, very practical in nature. It does happen. Now, few questions, these will actually open our mind to why different kind of insurance policies actually come into picture. So first is, what happens if the policyholder stops making payment? The reason could be anything. Second is, if the benefits are lapsed, because once, if somebody actually stops making the premium payment on time, the benefits will no longer, the benefits that the policyholder was enjoying will no longer accrue. They will cease to exist. So such benefits, can they be revived once the policy is lapsed? And the third question is, can the policyholder be convinced to renew his policy at reduced terms? Now let's think about it. What happens? Again, we take that same example of a 25-year-old person, healthy person, who is expected to live till the age of 75. That means up and from 25th year till 75th year, there is a good 50-year lifespan that we are talking about. So in this 50-year lifespan, a lot of things can happen. The person may lose his job, right? He may lose his job. He may find some better alternative. Right? So, or simply speaking, he is no longer interested in actually carrying out the insurance for some reason or the other. Maybe he's divorced, or he has never married. He thought initially then when he took out the policy that maybe he will marry someday and he will have a family, and for the family, it's essential that he takes out the policy. But then eventually, some years down the line, he decides not to settle down. A lot of things can happen. 50 years is a long time period, so obviously it's pretty hard to predict that how life is going to unfold, how our decisions are going to be shaped going forward. But nonetheless, what if in such a case, if the premium is stopped? So that means, let's take out an example. He takes out the policy in 25th year, and then initially he intended to carry on the policy up until his death. But let's say somewhere in the 45th year, he decides not to, right? Either he is compelled to discontinue the policy, or he decides on his own volition that he would not like to continue with this policy. What happens then? So the first thing that may come to your mind is that since he has dissociated himself, or he has actually discontinued the policy, so insurance company from this period onwards has actually no liability towards him. And yes, that's absolutely correct. Going forward, the insurance company has got no liability. But what about the premium? Let's say he was paying a premium of $5,000 each year. So for 20 years, this would be a sizable $100,000. So should the policy holder let go of this entire premium that he has paid? Think about it. Because if he discontinues, there is no other way around that we can think of, unless it is mentioned clear in no uncertain terms in the policy document itself. This $100,000 he would be forfeiting. There's a chance that he might forfeit. Second question is that, let's say after 45 years he discontinues the policy, but just after a year or two, he suddenly decides that, well, the discontinuation of the policy was not really a great idea. And can he go back to this insurance company and ask that, well, you know what, I had actually, discontinued this policy. The benefit seems to be lapsed, but I would want to revive this policy. I would want to continue with this policy once again. I would want to be part of this once again. So can the previous benefits which were accruing to him before his discontinuation, can they be added back? That means, can he have a cumulative effect since he is again continuing this policy, albeit after a couple of years of gap? The third thing is that, let's say he was paying a premium of $5,000, but let's say for one reason or the other, he is no longer in a position to pay $5,000 premium. So can he negotiate with the insurance company and say that, I like this insurance policy, But instead of 5,000, I will now be paying only 3,000 because that's what my financial condition has become right now. I will not be in a position to pay you $5,000 that I was paying before. So in this case, can the policyholder, still enjoy the policy yet at a reduced terms? Now think of it. Initially, to begin with, we simply described the whole or the ordinary life insurance. Now we have put forth to you 3 questions, and these 3 questions are pretty practical and pretty relevant, isn't it? The answer to all of them is yes, a solution can be found out. And these solutions are mostly charted out along the lines of these 3 insurance policies, which are a little bit different than the whole or the ordinary life policy. Which are these 3 policies? Well, endowment-based policy, variable life insurance policy, and universal life insurance policy. So let's discuss them one by one. First, we take out the variable life insurance policy. As the name suggests, the variable life insurance policy is actually a variation of the ordinary life insurance policy itself. And how is it? The payout consists of the guaranteed face value plus the accumulation value. Now, what is this accumulation value? Accumulation value is basically the value that actually accrues to the policyholder by virtue of the premium being invested in some suitable investment vehicle. What do we mean by that? Well, come to think of it, the whole or the ordinary life insurance policy, we merely talked about somebody actually paying $5,000 every year, and that $5,000 is going to grow to some corpus, and at the end of that period, upon his death or whenever it happens, the beneficiary to this policyholder is going to get 1 million. This is something which was discussed. Now, this 5,000 US dollar, obviously it is going to grow because this money is fixed. This particular money is fixed. This redemption value is fixed. So we can always find out that at what rate it is growing. That means that the crediting rate is pretty guaranteed. Why this crediting rate is guaranteed? Because the face value or the redemption value is guaranteed. You could work it out in your financial calculator as well in order to understand it better. But when we are talking about the variable life insurance company, the variable life insurance policy has got a couple of things. One, it has got a guaranteed face value, but another, it has got something called as accumulation value. Now, this accumulation value or something called as the bonus, that portion is not guaranteed. So let's come to think of it. What happened? So let's say we are talking about the same policyholder who was paying a premium of 5,000 US dollar. If it were a pure vanilla OLI, ordinary life insurance policy, and let's say the policy period was 50 years, so we can find out that, at 50 years, what is going to be the crediting rate. Let's just work it out. Maybe this will become easier for you. So we say PV is equal to minus 5,000. Please work it out the way I'm working it along with you. We say PMT is equal to, again, minus 5,000. And we say N is equal to 49. Why we are saying 49? Because we have taken one PV at the initiation of the policy itself. That is why we are saying N is equal to 49. And FV, we have got 1 million. So if you input this data and ask your calculator to finding out the CPT I by Y, I'm doing the same math at my end. So the I by Y comes out to be 4.85%. That means this is the crediting rate. What does this mean? This means that if the policyholder deposits a premium of 5,000 US dollar for the next 50 years, and he's guaranteed a payout of $1 million upon his death in the ordinary life insurance policy, the crediting rate happens to be 4.85%. Simply say this is the rate at which the premium actually grows to big to become the corpus of $1 million. So this portion is completely guaranteed under an OLI. But in case of a variable life insurance policy, it has got two components. One is obviously the insurance component, and another is called the investment component. Now, as before, the insurance component is guaranteed with the face value, but the investment component is not guaranteed, which puts it that the entire redemption value obviously cannot be known beforehand. It will depend upon few conditions. Nonetheless, one can have certain idea, and that is just about it. Okay. So in other words, the way it happens is that the accumulation value, which is a function of this investment, again depends upon a couple of things. One is that where the insurance company is actually investing the premium. Now, there are a couple of choices may actually exist. One is that the insurance company may deploy the premium at its own volition. That means the insurance company, at its own discretion. That means that the insurance company gets to decide where to invest the policyholder's premium. On the other hand, the insurance company also gives the choice to the policyholder, where the policyholder may actually pick up where he or she wants his premium to be invested each year. If he is a young person, maybe he would be risk seeking, and in that case, he may want his corpus to grow as much as possible. And in that case, he may pick up a risky proposition. That means he may ask his insurance company to invest his premium into risky investments. Some portion of it, not all of it. On the other hand, if we are talking about, let's say, a 45-year-old person who wants to take out a fresh policy, for him, obviously, the risk appetite is considerably low as compared to a 25-year-old person. So this person may decide, this new policyholder may decide that, well, he would not want the entire 100% of his premium to be invested into very risky ventures, but he may go into something called as a balancer fund. At 45, he is not too old, obviously, and he's not too young either. So he is at exactly almost at a we call it as a, he's at a midlife of his. So he may choose a balancer fund where he may decide that out of this 5,000 premium that he's paying, $5,000 premium that he's paying, $2,000 may be invested into equity market and $3,000 may be invested into debt market, high quality debt market. Okay. So this kind of choices are left with the policyholder, and that gets to decide how and how much the accumulation value would be at maturity. So here, in case of variable life insurance, few points of differences that we need to understand. One is that it is a variation of the ordinary life insurance, but unlike an ordinary life insurance, the face value of insurance is not fully guaranteed. Why? Because a significant portion of it is actually dependent upon the type of investment vehicle being chosen and where the premium is being invested. Third important aspect is that in a variable life insurance, the policy holder gets to decide where he would want to actually invest the fund. Sometimes we call that the unit linked plan, or ULIP in short. Now, one may actually wonder that why somebody would want to actually mix insurance and investment in the same basket. There could be various reasons. Reason number one is not everybody is sophisticated, not everybody is knowledgeable enough to make their own investment decisions. And in that case, it's perhaps best that they actually rely upon the insurance companies to make the investment on their behalf and let the corpus grow. But some of them may want to actually use the life insurance route, more precisely the variable life insurance route, to park their investments. Why? Because of the tax benefit. As we have discussed earlier, that variable life, any insurance policy, wherever we are paying the premium, those premiums are tax deductible. So because of this, the policyholder may actually decide for a variable life insurance where he not only gets the benefit of insurance, but also lets his investment grow in a tax-free manner. So as I said, that it accounts for tax benefit. Obviously, the variable life insurance is best suited if the horizon is a long-term one and if the person has a higher risk appetite. Also, the variable life insurance is pretty flexible in nature, wherein if the person decides that he may not want to continue with the policy any longer, after the lock-in period, he may surrender the policy. Okay, let's now move our focus to the endowment-based policy. An endowment-based policy is again one more variation of the ordinary or the whole life insurance policy itself. But where it differs from the ordinary life insurance policy is that it provides an exit value while alive. We talked about the ordinary life policy or the whole life policy where the redemption can only take place at the death of the policyholder. However, in endowment-based policy and also in case of a variable life insurance policy, in both of these policies, the policyholder may interim exit that insurance policy and take out his corpus. It's possible, right? So in other words, it will come with a fixed term maturity of, let's say, 20 years. So if the person is alive up until 20 years, the person may actually decide that whether he would want to, at the end of the 20th year, whether he want to cash out this entire policy or he may want to actually re-initiate a new policy with a new term. In fact, the person may actually, after the lock-in period, let's say we are talking about a 50-year time span. So in this 50 years time span, a person who is right now 25-year-old, he takes out a policy with the objective of 50-year timeline, 50 years lifeline rather. And if let's say by the time he is 50 years old, that means 25 years down the line from his initiation of policy, if he wants to take out this policy, if he wants to surrender his policy, he could do that. So that is what is called as the exit value. So the exit value need not be necessarily at maturity, but the policyholder may actually discontinue the policy after the lock-in period. Of course, every insurance company has certain lock-in period, and beyond that lock-in period, the policyholder at his own discretion may take out the money. That means he may discontinue the policy and then get certain benefit out of that policy merely because he has paid certain premium. So the cash value is a combination of the cumulative premium being paid and the performance of the funds the policy invests in. Yes, we talked about. In morbidity, the policy can be cashed out, for example, critical illnesses. Yes, this is one beauty of endowment-based policy. For example, as we have said before here, that what if the person is not in a position to actually pay the premium going forward? Why? Because he may have lost the job. Or it could be so that he is critically ill. Because he is critically ill, he is unable to work. So if he's unable to work, of course, in that situation, he would be requiring the support of this policy all the more. So such insurance policies also do exist where even before the person actually dies in a very morbid situation, he can actually cash out that policy and perhaps use that policy amount either to get himself better treatment or perhaps compensate for the non-working of his, and so that his family is in a better position to actually run the household. Okay. If the policyholder makes the choice of investment vehicle, then it becomes a unit-linked plan, not truly an endowment plan. Yes, that's what we are talking about. So the difference between an endowment-based policy and a variable life insurance policy is that in variable life insurance policy, the policyholder gets to decide where he would want to invest his premium. In case of an endowment-based policy, it is the insurance company that decides where the premium would be invested. Now let's come to another sort of ordinary life insurance policy, which is called as the universal life insurance policy. As the name suggests, this is also a variation of the OLI. The Universal Life Insurance Policy, or the ULI, provides the flexibility of varying premium being paid from one policy year to another policy year. Because of such flexibility, the death benefit is also uncertain. Beyond the cost of insurance, the cash value is a function of the investment fund that the insurer invests in. The cost of insurance may increase with age. Because of the floor value, a minimum crediting rate is guaranteed. Borrowing is possible against the acquisition value at a favorable rate. Premium is considerably lower than that of the whole life insurance policy. Okay. So again, if you look at the whole exercise, it actually, all these three policies that we talked about, all these three insurances that we talked about, that is the endowment-based policy, variable life insurance policy, and the universal life insurance policy, all of them fundamentally answer or attempt to answer these three practical questions that we discussed just after discussing the whole or the ordinary life insurance policy. I repeat, what happens if the policyholder stops making payment, which is also known as the disintermediation? Why would the policyholder suddenly stop making payment? As we say, that he may have lost his job, or right now he is critically ill. So when he's critically ill, not only that he's not working, as not having any income, but also this may be the time when he would require the financial support the most. Or if he simply thinks that he has certain better alternative. All these three could be reason that why disintermediation can take place. Obviously, you may understand that after learning through the endowment-based policy, the variable life insurance policy, and the universal life insurance policy, any of these actually will answer these three questions. And what will happen? What happens is that this comes with actually choices. So the insurance market, what it tells us, that it is no longer a rigid insurance market wherein you'll have to pay by the rules that the insurance industry and the insurance company lay in front of you. No, they are giving you the flexibility, and you may exercise those options subject to your predicaments, your hurdles, or your doubts which you may be having, or any sort of constraints that you may face in reality going forward. So you need not be tied down with an insurance company just because you signed with that insurance company 20 years back. A lot of things can happen, a lot of things can change. And yes, the answer lies in all of these kind of variants of whole or ordinary life insurance policy. So you have an endowment policy where the exit option exists beyond the lock-in period. So as we said, that in this case, if the policyholder surrenders the policy after 20 or 25 years, he may still get something out of this policy because he has paid a premium of almost 25 years. So 25 years for 5,000, you may imagine that he has already paid 125,000 US dollar. If it were a pure plain vanilla ordinary life insurance, of course, he would get nothing. But if it were an endowment policy, not only that he's going to get this 125,000 premium back, but also this will come with certain crediting rate. So that means his main corpus will be growing at more than $125,000. So his exit value will definitely be more than $125,000. Which kind of policy gives us this flexibility? Endowment policy, we just discussed. Similar is the case with variable life insurance policy as well. Variable life insurance policy also gives you that exit opportunity, should you want to exit. Okay. Now, in case if you are critically ill, as we said, that the endowment policy, in such cases, because of the morbidity, the endowment policy can be cashed out. Secondly, what if the benefits lapse, can they be revived? So as we said, that if the person actually discontinues the policy after running it for, let's say, 20 odd years, and suddenly a couple of years down the line, he believes that, well, his earlier decision was not right, and he may want to actually continue the policy, he will want to reinitiate that policy without his previous benefits being affected. Can that be done? The answer is yes, that can be done. Okay. And in the third scenario, when we said that, he were earlier paying a premium of 5,000 US dollar, but now his financial condition does not allow him to pay a premium of 5,000, but he is only able to shell out $3,000 premium. So in that case, can still the previous benefit be made to remain intact, while the future benefit that is going to come will come with somewhat with a reduced term? Yes, that can also be affected through universal life insurance policy. For your benefit, I will again rehash this point. What does this say? ULI provides the flexibility of varying premium being paid from one policy year to another policy year. Of course, the total death benefit or the accumulative value, that will definitely be impacted because of this change, but nonetheless, it is better than all or nothing. Okay, now, in fact, with this as well, you can think that the person who was paying, let's say, 5,000 US dollar as his premium, and now he is, let's say, 50-year-old, and he is financially well off, and he thinks that perhaps his insurance corpus should grow. And he talks to his insurance companies and say that, well, you know what, I was paying a premium of 5,000 US dollar. Now I would want to increase this 5,000 US dollar to 10,000 US dollar. So earlier, my guaranteed payout, my sum assurance was, let's say, 1 million, but I wanted this sum assured to increase to, let's say, $3 million or $2.5 million. Can that be done? The answer is yes, it can be done. How? Again, if the policy is a universal life insurance policy, in that case, not only can you reduce your premium, but you may also increase your premium. So these are the various benefits that can be there along with the whole or the ordinary life insurance policy. So I believe that you have had a solid understanding of this particular portion of the life insurance, that is whole life insurance policy, endowment-based life insurance policy, variable life insurance policy, and universal life insurance policy. Now, from here, let's come to another sort of insurance policy, which we say is the term life insurance policy. Now, what is a term life insurance policy? So let's read out the gist points, the bullet points first. So the policy plan could be for 20 years. We set the term in case of a term life insurance policy. That is why it is called a term life insurance policy. So the policy plan could be for 20 years, and yet the term is valid only for one. What does that mean? We'll come to that later on. Does not accrue cash value. Unlike the whole or ordinary life insurance policy, it is mortality based and hence a pure insurance. The premium are fractional of the ordinary life insurance policy. Payouts are mostly tax exempt. Premium payment in most jurisdiction is also tax exempted, subject to a limit. Okay. So imagine a scenario that so far we have discussed about life insurance policy as not only a means of actually securing one's future, in fact, to secure one's family's future by taking out a policy which is going to stand good the test of time, should there be any eventuality, and compensate for the human capital. But also, the various types of life insurance policy save the pure OLI policy. Various types of life insurance policy also provides you the opportunity to build your investment purpose. So here we are not only talking about death benefit, we are also talking about some maturity benefit, and the maturity benefit that may accrue because of investment, prudent investment, that is. So most of the insurance policies that we talked about are of this nature. But if I were to actually strip this investment from the life insurance altogether, so what am I left with? I'm left with a pure life insurance policy, right? What do we mean? Well, all that I'm saying is that, let's say, again, I'm talking about a 25-year-old person, and he takes out a policy. In this case, the whole or ordinary life policy insurance does not really have a fixed maturity because it is impossible for us to know when a person would die, right? But let's say for a term insurance life policy, The 25-year-old person takes out a policy for the next 35 odd years. For the next 35 odd years. So that means by the time he becomes 60, that he retires. So his life is covered for his entire working life. I mean, his human capital is being covered for his entire working life, assuming that he works till the age of 60. So in this scenario, a insurance policy can be thought of where this person, maybe he's a financial advisor, or maybe he is somebody who is pretty well versed with investments and capital markets, and he decides that I don't need my insurance company to tell me how my corpus would grow. I would want to keep these two things separate. I would want to keep my insurance separate. I would want to keep my insurance separate from my investment. And he negotiates with the insurance company and says that, you don't tell me about the investment aspect, the accumulation value, the cash value, the maturity benefits of your insurance. I just want a plain vanilla insurance wherein I'm going to pay you a premium for the next 35 odd years. If I don't die, you can keep that premium with you. I don't want that premium back. But if I do die, in that case, my family is going to be compensated for $1 million. Can an insurance policy of such nature can be worked out? The answer is yes. And that type of insurance policy is exactly what we call as a term life policy. So in case of a term life policy, it goes like this, that the policy holder will take out the policy for a fixed term. However, the validity of the term policy is always going to be only for a year. What does that mean? Well, it means that if he takes out the policy on year 0, he pays the premium for 1 year, he pays the premium for 2nd year, and he does not pay the premium for 3rd year. If he does not pay for the premium for the 3rd year, then his first 2 years premium that he has paid is completely forfeited. That means this policy is only valid for 3rd year, only valid for a couple of years. In the 3rd year, he has not paid any premium, so the entire premium is forfeited. And suppose after paying for 5 years, unfortunately between the 5th and 6th year, he actually dies. If he dies, then he has paid a premium only for 5 years, and yet his family is going to get the entire lump sum value of 1 million. You would say, well, how is it different then from the whole or of the ordinary life insurance policy? Because that would also going to cash out, that is also going to affect a payment of 1 million. Yes, it is going to make the payment of 1 million exactly the same manner as we are talking about here. However, this term life insurance will carry a significant less amount of premium as compared to an ordinary life insurance policy. So to secure that OLI policy that we discussed for a sum assured of 1 million, if one had to shell out of, let's say, 5,000 US dollar, in case of term life policy, it could only be 2,000 or let's say 2,500 US dollar. Why? Because 3 particular reasons. Reason number 1, term life policy comes with a fixed term. It does not continue till life. It comes with a fixed term. Second, there is no such thing as cash value. What does this mean? It means that the insurance company does not give you any commitment. It does not commit to you what if there can be any sort of accumulation value at the end of your policy tenure. No, insurance company does not make any such kind of forward commitment. And the third thing is that should the policy holder discontinue the policy at any given point in time, simply by not paying the premium, the entire previous premium that he has paid up until that period of time, that is completely forfeited without any chance of recourse. So because of 3 fundamental differences, the premium for a term life insurance, even for the same sum assured, is considerably lower than that of an ordinary life policy. And that is why a term life insurance is sometimes called as a pure insurance. All right. So before we actually close in about which insurance policy one should choose as far as the life insurance is concerned, well, it depends from person to person. And then there are a host of factors that would need to be taken into consideration. And it's an individual's own judgment, along with choice, along with the kind of knowledge that the individual may possess about insurance that would help him or her to make an informed decision. But few of the pointers that we can think of is that before choosing the policy, these questions must be asked. Is there a specific retirement goal? And can that goal be quantified into monetary terms? That means before you're taking out this policy, do you have any idea that if you're starting out your career today, by the time you retire, where would you be financially? What is your post-retirement goal? Are you planning for your child's future? Are you looking at the insurance policy as a mean of investment purpose as well? Do you have the tax benefit idea? Do you want your policies to having some sort of, to accord you some sort of flexibility in terms of premium payment? Because as we said before, that today an individual may be well positioned to pay 5,000 US dollar as part of premium every year. Going forward, his situation may deteriorate and he will only be able to shell out $3,000 as annual payment towards premium, or his financial situation may actually improve a lot, which may actually put him in a better pedestal where he may actually bargain. We could actually, go back to the insurance company and top up his insurance policy by paying additional premium. So this kind of flexibility is that something that a person is actually looking forward to? Or he's managing his own investment. He's not bothered about the investment portion. He is simply bothered about the mortality benefit. Is he looking forward to building a huge corpus? So all of these questions, these are not exhaustive in nature, but all of these questions need to be answered before one may actually make an informed decision and pick up the insurance policy that suits his or her purpose the best. Now, a few pointers before we move in to the next topic, that not having a life insurance policy is definitely a poor decision for a working individual. Mind you, the word working individual is important. Why? Because life insurance substitutes or compensates for the human capital. That is the potential that the person could have worked for the next forthcoming 20 years, 10 years, 15 years, 30 years, that he could not because of his sudden demise. An insurance company substitutes for that. So obviously, not having a life insurance policy is definitely a poor decision. But if you think from the insurance company's perspective, losing an existing policyholder is equally detrimental to the insurance company. Why? Well, come to think of it, at the beginning of the chapter itself, we said that the business of insurance is all about pooling of risk and reward. Pooling of risk and reward, right? Which means that only 2 out of 100 will be there on any given year to land a claim. Right? So, if an insurance company is losing its existing policyholder because of disintermediation, because of any goddamn reasons that you can think of, that means his denominator is also decreasing. And the insurance company would not want to do that. Why? Because the more policyholder the insurance company has, the more diverse its program could be, its risk management could be altogether. Okay. So from now here, we dive into the mortality table problem. I have had a separate video made out for the mortality table calculation of premium and how to work around the mortality table problem. We will refer to those. Definitely, I would want all of you to refer to that as well. But let me give you a brief idea about what is mortality table, how to work around this, and what to understand out of this. Okay. So think of it that how an insurance company prices its insurance product. In other words, when we say that, we are talking about a premium, how the premium is being calculated, how the insurance company arrives at a certain value. Did you ever think of it? Especially with regards to the life insurance? Well, here's the answer. The insurance companies, life insurance companies, have actuaries working for them. Who are these actuaries? Well, the actuaries are the ones who have had a fair bit of an understanding, in fact, very deep understanding of not only of insurance, but also statistics. So what the actuaries do is they refer to certain published data from the National Bureau of Statistics. And which published data we are referring to? Well, we are talking about the mortality rate across different age group that the Human Resource Ministry of a particular country or the National Bureau of Statistics of a particular country would be publishing from one year to another. And let's look at this column. So this particular column, which we are going to, this is column 0, this is column 1, this is 2, and this is 3. Similarly, for female, this is column 1, this is 2, and this is 3. Okay, so this mortality table, what it means, let's get a hang of it. It says if we are having a 30-year-old person, okay, so the probability that this person would die in the next 1 year, that is a 30-year-old person, maybe a healthy person, would die in the next 1 year, that probability is given by this particular figure, which is 0.001498, or in other words, it is close to, if we convert them into percentage, it is going to be 0.491498, or roughly speaking 0.15%. Okay. Similarly, if we are talking about a 50-year-old person, a 50-year-old person would die in the next 1 year, the probability of the same is 0.49, or roughly say 0.5%. Okay. Now, please understand, there are few things that are pertinent, that these data are purely random in nature. These data are purely random in nature. Okay. And secondly, these are referred universally as being published by